Okay, so let's start from where we left. Let's continue from where we left. Last time we were discussing the topic of external reconstruction. And that's the topic we want to finish now. That's the topic we want to finish. So let's continue from where we left. Okay. So maybe before we continue from where we stopped, let me remind you what we did. We were discussing the topic of conversion, we were discussing the topic of external reconstruction. And this is what we had said. Let me take you back so that we know where we were. Okay, this is where we were. We were saying this. Whenever you have an external reconstruction, we said a company, which we were assuming to be company A, we said that company is liquidated. That company is liquidated so that they sell their business to another company, which we were assuming to be company B. Company A, which is selling their business to company B, we said we shall be calling it the selling company. We said we shall be calling it the selling company. And I told you, company A must liquidate themselves. In other words, the stakeholders of the company, whenever a company is liquidated, you know, the stakeholders by the end of the day must be paid what is due to them so that everybody goes their way. So we concluded by saying company A will have to close their books. Company B, which is buying A, we said we shall be referring to it as the purchasing company. And so we also concluded and said there, then they will be opening their books. So for them, they will be preparing what we call the opening accounts. For the company A, they'll be preparing what we call the closing accounts. Good. Then we started the entries in the books of the selling company to close their accounts. And it looks like we had gone up to number what? We had gone up to number 11. Up to number 10, I think. I'll confirm. Number 10, I think so. So let me just remind you very fast so that we connect with where we stopped last time. Company A is selling their business to company B. So what are the accounting entries company A will have to make? Number one, I told you, company A will have to close all the assets that were taken over from it by the purchasing company. Company A will have to close them at their book values. So I said, number one, UA, close all assets taken over by the purchasing company at their book values to an account you are calling what? To an account you are calling realization account. We were saying assets are always a debit balance. So to close them, you credit the asset and you debit realization. You can see there, that was number one. That with the assets taken over, we said you debit realization, you credit assets. That was number one. Number two, we said with the liabilities that were taken over from you, your company A, could be decided. You will take over your debentures, take over your loan, take over your creditors. So number two, we said, you as company A, whatever liabilities you are giving to company B, you close them again. To which account? To an account we were calling realization again. We were saying liabilities are always a credit balance. Liabilities are always a credit balance. Therefore, to close them, we said you will debit liability. You can see here, we said you credit realization. That was our step number two. Number three, we said, when you as company A, you are selling your business to company B, you as company A, there must be something you are charging company B. What is it that you are charging them to buy you? Whatever you are charging them to buy you, That's what we were calling the purchase consideration. That's what we were calling the purchase consideration. And I was telling you, at this point in time, you want to charge them that amount. We were assuming, I remember, something like 50 million. We were assuming 50 million. And so I said, you charge them. You, A, charge company B that 50 million. They are not paying you now, but we said you charge them. In other words, we said, create a data now to be paid in the future for you to receive. So number 3, we said, with the purchase consideration again, with the purchase consideration, which we were assuming to be 50 million, you can see here, we were saying you debit the purchasing company, which we are assuming company B as our purchasing company. We said you debit the purchasing company, and we said you credit realization. You credit realization. That way, I said, you have created a data by the name of company B. By the name of company B. Good. Again, let me mention something before we continue. It's a free class again today. Listen, it's a free class today. That means there are some new students who have joined. I want to explain something to them. The others are already aware, but for the new students again, because today is a free class. Listen. 1, the point is, sometimes, listen to this, sometimes you may be disconnected. Sometimes you may be disconnected when you are watching a live class, because one way or another, your Wi-Fi may be weak from your point, and therefore you are disconnected. I said, and I've been saying, in case you are disconnected, how can you come back to class? You may try and click the disconnected video. Listen, you may try and click the disconnected video, and it doesn't bring you back to class. I said, the other way to come back to class is, 1, you go and refresh the page. I said that on the top left or on the top right of your page where you are watching this video from, normally there is a refresh button. So you can refresh the page by clicking that refresh button. That will bring you back to class. Then I said, there are some gadgets that don't have the refresh button on the top left or top right. So how else can you come back to class? You go and click on the link that was sent to the group. Wherever you pick the link, go back and click the link again. In the group where the link was sent, go and click the link again. Those are 2 ways in which you can come back to class. If you try and click the disconnected video and it doesn't come back, it doesn't bring you back to class, we have said refresh the page by clicking the refresh button. If you don't have the refresh button, go back and click on the link that was sent to you. Then that will bring you back to class. Good. Okay, now the other thing I may want to appeal to those who have not joined my subscription, please listen. If you are a member who has not subscribed to my YouTube channel, please subscribe. If you have not subscribed to my YouTube channel, please subscribe by clicking the subscription button down there. Even as you are watching, maybe you have not subscribed, please click on the subscription button down there so that you get to be notified whenever we post new videos in the YouTube. So please subscribe by clicking the subscription button. You can even do it right now, and then also click the notification bell to notify you whenever we are posting new videos. So please do that. Okay, so let's now continue. So I think I've brought the new students into the picture now. I've brought them into the picture now so we can continue. So let's continue. So I was going on with the entries we had done last time, and that was, we were at entry number 3. We were at entry number 3, where I was saying, with the purchase consideration, you as company A, how much are you charging company B? You are charging them 50 million. And so we debit the purchasing company. I told you to do what? To create a data. And I told you, you credit realization. That was our number 3 entry. Number 4, let's go on. Number 4 tukasema with the liquidation expenses. I told you this. When you as a company A, you are just give it a minute. Yes, sour. So I was saying this, number 4. You as company A, whenever you are selling your business to company B, you company A, you must liquidate yourself. Then I told you, in the process of liquidating yourself, you may be required to incur some liquidation expenses. And so we said number 4, with the liquidation expenses, listen, if you company A, you paid it on your own, you paid for that liquidation expenses on your own, we said you will debit realization. That was the entry. We said you debit realization and you credit bank. That's what we said. With any liquidation expenses, if paid, that's what we said. If paid by the selling company, we said you debit realization and you credit bank. Then I told you, listen, sometimes you company A, you may want to liquidate yourself so that you can sell your business to company B, but you don't have the money to liquidate yourself. So, because B wants to buy you, and you don't have the money to liquidate yourself, company B tells you he will pay for you your liquidation expenses. Remember, it is your cost. I told you, company A, that liquidation expense is your cost. Maybe it's 2 million shillings that you need. It is your cost. But you may not be in a position to pay. But because company B wants to buy you, they say they will pay it for you. So what happens? Listen, we normally say, therefore, you company A, you have incurred but not paid. You have incurred that expense but not paid. So if you have incurred but not paid, we said you still debit realization. I hope you remember. You still debit realization, and then we said you credit an account we were calling provision for liquidation expense. You debit realization and you credit this account called provision, meaning you are creating a liability in this account called provision, so that once you receive the money from company B, you will now pay this liability by debiting the liability and crediting bank. That was our entry number 4, which said with liquidation expenses, if you paid it, debit realization, credit bank. That was number 4. Number 5. For number 5, I took you, listen, for number 5, I took you to number 1. Number 1, we said with the assets taken over. Then I said, what about you, company A? What if you have some assets that you have, but company B does not want to take them over from you? And we said, because we are liquidating company A, you company A, you can't leave some account spending. But there are some assets company B does not want to take over from you. So what do? You could decide to sell them on your own. So number 5, we said, with any assets not taken over by the purchasing company, but sold by the selling company, you will debit bank because you are selling the asset, and you'll credit the asset. You can see here, last time we were assuming it is motor vehicle, where we were assuming, suppose the value of the motor vehicle is 2 million, you sold it for 2.5 million, you will debit bank and you will credit the asset. You will debit bank and you credit the asset. Then we said, with the balance in the asset account, that balance could either be a gain or loss on disposal. We said you transfer it where? We said you transfer it to the realization account. We said you transfer it to the realization account. So that was our entry number 6. Number 5, sorry, which says, with any assets not taken over by the purchasing company but sold by the selling company, you debit bank, you credit the asset. And any balance in the asset account, being a gain or loss on disposal, you transfer it to the realization account. That was number 5. Number 6. For number 6 again, I took you back to number 2. Number 2, we said with liabilities taken over. Then I told you, what if you, company A, you have some liabilities which you have, but company B does not want to take them over? Could be it's creditors that company B decided they're not going to take over your creditors. So what do? You decide, maybe you, company A, you decide you're going to pay that liability on your own. So our number 6, we said, with liabilities not taken over by the purchasing company, but paid by the selling company, we said you debit the liability and credit bank. You can see here, we were assuming an asset liability called creditors. We were assuming, suppose the creditors balance brought down is 2 million. Then the question tells you the creditors were willing to accept 1.8 million in full. So you debited creditors by 1.8 and you credited bank. We said, but we owe them 2 million. They were willing to accept 1.8 million. We said, you can't leave this account like this. Why? Because we are liquidating the company and we cannot leave some accounts pending. So this 200,000, we said, you consider it as a discount that you are receiving from creditors. And that discount, we said you take it to the realization account. I hope you still remember I told you, don't take it to the P&L account. We know it's a gain, but don't forget I said we are not running a normal business. We are reconstructing this company A. And the operating account, we said, is the realization account. It's the realization account. Good. So that was our entry number 6. With liabilities not taken over by the purchasing company but paid by the selling company, we said you debit the liabilities and you credit bank. Then we went on and said if there's any discount received from creditors, you debit creditors and you credit realization. That was our entry number 6. Number 7. Number 7, here, listen. I want to get the point here. I told you number 7, 8 and 9. I hope you remember. Number 7, 8 and 9. I told you they are all related. Let me remind you. We said whenever a company is liquidated, the stakeholders of the company normally should be paid what is due to them. We said one group of stakeholders are the ordinary shareholders. And as a company A, there is a lot you owe to the ordinary shareholders. But we said you can't pay them everything that you owe to them through those various accounts. Like, for example, I owe them for their share capital. I owe them as a company A, I owe them for their share premium, maybe general reserve, revaluation reserve. All these are things that belong to the ordinary shareholders. We said it's true they must be paid what is due to them. But we said you can't pay the ordinary shareholders what you owe to them through those various accounts. That is through share capital, through share premium, through general reserve, through revaluation reserve. No. We said you create a liability account for everything that you owe to the ordinary shareholders, for everything that you owe to them, so that when the time of payment comes, you only pay them as a lump sum. So that liability account, listen, that liability account that belongs to the ordinary shareholders is an account we were calling the ordinary shareholders members account. So you can now see number 7, we were saying transfer the balance of the ordinary share capital to what? To the ordinary shareholders members. So transfer that balance to the liability account. So we said share capital is always a credit balance. Share capital is always a credit balance. And therefore, to close it, we said you debit share capital and you credit the ordinary shareholders members. That's what we did by the amount of the share capital. That was our entry number 7. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. That was number 7. Number 8 tukasema, you also transfer reserves they also belong to the shareholders. Whether the reserve is share premium, general reserve, whichever reserve, give it to the ordinary shareholders. It belongs to them. So number 8, tukasema transfer reserves. If we went further and said, if the reserve is a positive reserve, like share premium, general reserve, revaluation reserve, you close it by debiting that share premium and crediting ordinary shareholders members. Or if it's a general reserve, you debit general reserve, you credit ordinary shareholders members. Then we went further and said, what if that reserve is a negative reserve, like the retained losses? Because losses, we said, are always a debit balance. When you go to the P&L account of this company, you will find a retained loss, and a retained loss is always a debit balance. It is an amount that belongs to the ordinary shareholders. And so we said, give it to them. Being a debit balance, go close that P&L account. It's a debit balance in the P&L account. You close it by crediting P&L account, and we said you debit the members. That was our entry number 8, which said transfer reserves to the ordinary shareholders members. I told you whether positive reserve or a negative reserve, it doesn't matter. Give it to them. That was number 8. Number 9. For number 9, I hope you remember, I took you back to number 1 and to number 5. Number 1, we said, close all assets taken over. Number 5, we said, with assets not taken over by the purchasing company but sold by the selling company. Then I told you, what if you, company A, you have an asset which company B does not want to take over from you under number 1? At the same time, you A, you could not get somebody to sell it to under number 5. What do you do? And yet we are liquidating company A. And I said you can't leave some accounts pending. So if you have such an asset which cannot be taken over by the purchasing company, and you, company A, you could get somebody to sell it to, I said somebody within your company must take over the loss of such assets. And who are those guys who must take over the loss? We said these are the ordinary shareholders. They are the owners of the company. And we were saying examples of such assets include intangible assets, copyrights, goodwill, trademarks. These are assets that B does not want. And 2, you can't sell them. So who takes over the loss of such assets? We said they are the ordinary shareholders. So our step number 9, we said you transfer fictitious assets, whatever they are, transfer fictitious assets to the ordinary shareholders members. So we were debiting ordinary shareholders members. Let me show you down here. We were debiting ordinary shareholders members and crediting fictitious assets. That was our entry number 9. 10. Listen, I told you, if your company has preference shareholders also, you will have to pay them what is due to them. But again, you can't pay them their capital through their capital account. No. Just like you have done for the ordinary shareholders, we said, open another liability account for the preference shareholders so that anything you owe to them will go into that account. So that when it comes to me paying them, I don't pay them in piecemeal basis. I pay them everything at once. Good. And so we said, step number 10 says, transfer the balance of the preference share capital, to the preference shareholders members. So we debit preference share capital, you can see, and we said you credit preference shareholders members. That was our entry number 10. Still on number 10, we went further and said, in case your company, you company A, in case your company has not been paying the preference shareholders their dividends, meaning you have preference dividends in arrears, maybe for the last 2 years, 3 years, and so on, we said preference dividends in arrears don't appear in the balance sheet. But now that you are reconstructing the company, we said you must crystallize them, make it a liability. So we went further still under number 10, tukasema, if there are any preference dividends in arrears, we said you debit realization. That's what we said. We debit realization. You can see it here. We said you debit realization and you credit the preference shareholders members account. Good. That was our step number 10. Number 11. Number 11, I took you to number 3. Number 3 said what? With the purchase consideration. We have to debit the purchasing company. You can see here 50 million. We have to credit realization. Then I said, under number 11, a time has come now for company B to pay us. A time has come for B to pay us. We said, B can decide to pay you as company A that 50 million, either in terms of cash, or in terms of shares, or in terms of debentures, or whatever form. So we said, suppose the question tells you that company B decided that out of the 50 million, they would pay 10 million in terms of cash, 20 million in terms of shares, and another 20 million in terms of debentures. That's what you read from the question. So you, A, you are receiving these things from B. So number 11, we said, with the receipt of the purchase consideration. With the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are receiving cash, I said, you debit cash. Where did we open that cash small account? Can't see it where we opened it. But wherever we have, let me squeeze it here. You said, if you are receiving cash, you debit cash and you credit the purchasing company. If you are receiving shares, we said you debit shares. Remember, you are receiving. Listen, I say you are not issuing the shares, you are receiving the shares. So to you, the shares are an asset. So you will debit the shares and credit the purchasing company. Then I said, if you are receiving debentures as a payment, again, you are receiving the debentures as a payment, as an asset. You are not the one issuing the debenture, it's the other company issuing. You as A, you are receiving it. So you will debit debenture and you will credit the purchasing company. That was our entry number 11. And I think that's how far we had gone. So we want to pick it up from there now and continue with the remaining 4. I told you, in the books of the selling company, we have 15 accounting entries. So far we have done 11. Let's now go to number 12, 13, 14, and 15. Now listen, as we continue together now. I do hope we had written all of them. Those ones, yes, I can see we had written the summary notes are good. For up to number 11, good. We had written the entries. Now let's continue. Let's now continue. Now listen to this now. In number 11, we have just received cash. We have received shares. We have received debentures. Listen carefully now. You are company A and you owe 2 groups of people some money. You owe the ordinary shareholders and you owe the preference shareholders. Now that you have received these assets, the question is, who should you pay first? Who should you pay first? Should you pay the ordinary shareholders or should you pay the preference shareholders? You know, listen, you know that when a company is liquidated, preference shareholders normally rank first in order of priority. They rank first in order of priority. So you will be going back to the question. Listen, you have received cash, you have received shares, you have received debentures. Go back to the question and find out which of these three things are you using to pay the preference shareholders. The question will guide you as to which one of them you are using to pay the preference shareholders. So in other words, we are saying step number 12 now says pay the preference shareholders what is due to them. You pay the preference shareholders what is due to them. Either you are paying them in cash, or you are giving them shares, or you are giving them debentures. The question will tell you what it is that you are giving to them. So listen, if the question tells you you are giving them cash, go credit that cash and you debit the preference shareholders members. Don't forget you had opened the account for them. So you come and say your cash, whatever it is. If the question tells you you are giving them shares, go credit the shares account. You debited it. Now go credit it here. Where is it? It's here. Go credit the shares account and debit the preference shareholders members. That's what we are saying. You come and debit here. You say here shares. If the question tells you you are giving them debentures, go credit that debenture and you debit the members. Whatever it is. That's our step number 12, which says pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. You debit the preference shareholders members account, you credit either cash, you credit shares, or you can credit debentures depending with the question. That's our entry number 12. Let me go to number 13 so that we put them down again, all of them at once. That's number 12. Number 13. For number 13, before I put it there, let me come back to that account. This account called preference shareholders members. Look at it. Suppose, you know we have said, on the credit side, this is what you owe the preference shareholders. On the credit side, that's what you owe to them. Let me assume for purpose of illustration that what we owe to them is 2,000 or 2 million. Let me assume so. On the debit, we have what we are giving to them as a payment, either in cash, shares, or debentures. For purpose of illustration, let me assume all that amounts to, all of them amount to 1.8 million. I owe my preference shareholders 2 million on the credit side, but as per the question, I'm paying them a total of 1.8 million, which means the balance in this account will either be a gain or loss on payment. I owe my preference shareholders 2 million, but they are willing to accept 1.8 million. So it is obvious I am paying them less than what I owe to them. As company A, I am paying them less than what I owe to them, and therefore that's a gain to us. So you A, you will debit this account called preference shareholders members. You will debit preference shareholders members and you will credit the account we are calling realization. You take it to your realization account. Take it to the realization account. Whatever the amount, it's a gain. Alternatively, we can also assume, suppose on the credit side you owe them 2 million, as it was, but maybe now when you add the payments, it comes to 2.8. Let us assume so. Suppose now the total payments came to 2.8. You owe them 2 million, but they are being paid 2.8 on the debit. So you are paying more than what you owe to them. I'm paying them 2.8, but I owe them 2 million. There's a difference of 800 on the credit side. That means I'm paying them more than I owe to them. To me as company A, that's a loss to me. That's a loss to me. Again, take that loss to the realization account. You will credit preference shareholders members and you debit realization account. That was our step number, or that is our step number 13. which says, listen, with the balance in the preference shareholders members, with the balance in the preference shareholders members being either a gain or loss on payment, being either a gain or loss on payment, you transfer it to the realization account. You transfer it to the realization account. Good. That's step number 13. Let me go to number 14 now. For number 14, listen, you come back to step 11, to this account called realization. For number 14, we want to get the balance in the realization account. Now listen, whatever is the balance we shall be getting in this realization account, we normally call it either a gain or loss on realization. In other words, you want to know, as company A, did we sell our business at a gain or loss? We are selling our business to company B. So are we selling our business at a gain or loss? So the balance in the realization account, that balance will either be a gain or loss on realization. Suppose the balance is on the debit side. Remember, on the credit side of this realization, that's what you gave out. No, that's what you are charging the company. You are charging B 15 million. But on the debit side, this is what you gave out in terms of assets and the cost you incurred. So if the balancing figure is on the debit side, what does it mean? It means that you are going to receive more than what you gave out. What you gave out is on the debit side in terms of assets and plus the expenses you incurred. But what you are receiving is on the credit side. So if the credit side is more than the debit side, it means you're going to receive more than you're giving out. To you as company A, that's a gain. Listen, who takes over the gain of selling the business? It is obvious are the owners of the company. And who are the owners? The ordinary shareholders. So our step number 14, our step number 14 says, with the balance in the realization account being either a gain or loss on realization. If it's a gain, like we are assuming now, you will debit realization and you will credit ordinary shareholders members. Give the ordinary shareholders their gain. You will debit realization and you credit ordinary shareholders members. And you come and say your realization. Otherwise, if the difference in the realization account was on the credit side, meaning what you are giving out on the debit is more than what you are receiving on the credit, then it means you as company A, you are selling your business at a loss. You are selling your business at a loss. Again, who takes over the loss of that business? It is the owners of the company who are the ordinary shareholders. So I would credit realization and I would debit the ordinary shareholders members. So that's our step number 14, which says, with the balance in the realization account being either gain or loss on realization. If it's a gain, you debit realization, credit ordinary shareholders members. If it's a loss, you debit ordinary shareholders members, you credit realization. That's our step number 14, which says, with the balance in the realization account. Good. Finally, number 15. Of course, we have already paid the preference. So the last person to be paid in a liquidation, obvious, it's the ordinary shareholders. So last final entry is pay the ordinary shareholders what is due to them. Pay the ordinary shareholders. Listen, again, the question will guide you. Remember, you received cash, you received shares, you received debentures. The question will guide you as to what you are giving to the ordinary shareholders. Again, if you are giving them cash, go credit cash, debit the ordinary shareholders members here. You come and say your cash. whatever it is. If you are giving them debentures, go credit debentures and debit the members here. If you are giving them shares, go credit the shares and debit the members. Whatever it is, they are the last people to be paid. Listen, once you pay them, there should be no account with any balance at all. Why? Because they have even taken over the loss of selling of the business. They have taken over the loss of selling of the business. So once I finally pay the ordinary shareholders, all accounts should be closed. All accounts should be closed. Of course, we shall do an illustration to show that effect. But those are the 15 accounting entries in the books of the selling company. So we had already written up to number 11. We had already written up to number 11. So let's go to number 12 now. 13, 14, and 15 in the books of the selling company. So let's continue with our accounting entries now. Let's continue with our accounting entries. We stopped at number 11 last time. Now we want to go to number 12. Number 11, we had already said with the receipt of the purchase consideration. You can see here, with the receipt of the purchase consideration, we had debited cash, debited shares, credited debentures. We had credited the purchasing company. That 50 million. Okay. Now that we have received it, we said, now who do you pay first? We have just said a short while ago, you pay the preference shareholders. So andika number 12, put it down, number 12. Number 12, pay the preference shareholders. Number 12, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. I've said number 12, pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. Then put down the double entry now, debit preference shareholders members. Those are the guys we are paying. Debit preference shareholders members. Credit cash, stroke, shares, stroke, debentures. I told you, you received them as an asset. Now you are using them to pay. So you credit. That's our number 12. Finish. We want to go to number 13 now. Finish. We want to go to number 13. We want to go to number 13 now. Put it down. Number 13. Number 13. With the balance in the preference shareholders members account. With the balance in the preference shareholders members account. With the balance in the preference shareholders members account. Being either a gain or loss on payment. With the balance in the preference shareholders members account being either a gain or loss on payment. Debit, maybe you can say number A, with the balance in the preference shareholders members account being either gain or loss on payment. You can say number A, if gain, I debit preference shareholders members, and I credit a realization. Debit preference shareholders members, you credit realization. Don't forget, let me just show something account on the side there, just to remind you. Here we are. We were saying preference shareholders members here. Listen, if you owe them 2 million and you are paying them 1.8, there's a difference of 200. That's what I was saying. You debit preference shareholders members and you credit realization. That's a gain. Then number B, put it down. B, if loss. That means now you are paying them more. If loss, debit, realization, credit, preference shareholders members. Debit, realization, credit, preference shareholders members. Debit, realization, credit, preference shareholders members. That's our step number 13. We want to go to number 14 now. We want to go to number 14. To finish, we go to number 14. Number 14, we were saying, put it down, with the balance in the realization account. With the balance in the realization account. With the balance in the realization account being either, with the balance in the realization account being either a gain or loss on realization. With the balance in the realization account being either a gain or loss on realization. Being either a gain or loss on realization. Number A, if gain, remember I was saying, just to remind you, you are receiving more on the credit than what you are giving out. So there's a difference on the debit. If gain, we said you debit realization and you credit ordinary shareholders members. They are the owners of the company, so they take over the gain or they take over the loss. You debit realization and you credit ordinary shareholders members. That's what we said if it's a gain. Number B, if loss. Remember we were saying on the debit you have more than what you are receiving on the credit in that account called realization. On the debit you have given out more than what you are receiving, that's a loss. So we said you debit ordinary shareholders members, you debit ordinary shareholders members, and you credit realization. That is if it's a loss. You debit realization, you debit ordinary shareholders members, and you credit realization. And you credit realization. Good. That was our step number 14. To finish, we want to go to number 15, the last one. We want to go to number 15, the last one. Number 15, you can put it down. I've already discussed it. Number 15, pay the ordinary shareholders what is due to them. Number 15, pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Either in form of cash, shares, or debentures. Pay the ordinary shareholders what is due to them. Either in form of cash, shares, or debentures. Debit, ordinary shareholders members. We are paying a liability, so we debit it. Ordinary shareholders members. Ordinary shareholders members, credit cash. You're giving them either cash or shares or debentures. Good. So those are the 15 accounting entries in the books of the selling company. There are many, but it's required you should remember them. There are many, but it's required you should remember those entries. You should remember those entries. So finish, I want to go to the books of the purchasing now. For them, we said they will have to open their accounts. How will they prepare their opening accounts? For them, the entries are not many. For them, the entries are not many as the books of the selling. But it's also good to remember the books of the selling, those 15 accounting entries. To finish, I want to discuss the entries in the books of the selling, in the books of the purchasing. We are through with the 15 entries in the books of the selling. I hope you are through. I hope you are through with the books of the selling. Now, listen. Listen now. Before I talk about the books of the purchasing, just get an overview. Listen, get an overview of the books of the selling. They are not complicated. Listen. First things we started with, listen, was close. Number one, like I was saying, close the account of the asset. 2, liabilities taken over, close it. Number 3, with the purchase consideration, charge, be limited. Number 4, with the with the liquidation expenses, how much are they incurring to liquidate themselves? Listen, those 4, listen carefully, those 4 are always a must find in any question. Closing the account assets, that one you have to do. Closing the liabilities taken over, that you have to do. With the purchase consideration, you have to charge. With the liquidation expenses, the question will guide you. Listen, most questions don't have number 5 and 6. Most questions don't have number 5 and 6. In other words, they don't have somewhere you are told A could not give out this asset, and so they sold it on their own. Yes, you could have a question, but most of your questions don't have where company A sold an asset on its own. 6, where company A paid a liability on its own. Most questions you don't have. So for number 5 and 6, most questions don't have it. But it's good to know that in case you did not sell your asset, you did not give out your asset, but you sold it on your own, then what do you do? If you did not give out your liability, but you paid it on your own, you now know what to do. So number 5 and 6 is not a must. But listen, 7, 8, and 9. 7, 8, and 9. It is obvious you will find them. Because now you have to pay the owners. Who are the owners? The ordinary shareholders. I told you you can't pay them what you owe to them through those piecemeal accounts. Share capital, share premium, general reserve, revaluation reserve, retained losses. No. Combine everything in one account for them. That's all involved in number 6, 7, number 7, 8, and 9. 7, transfer the balance of the ordinary share capital to the members' account. 8, transfer reserves, whether positive or negative. Number 9, transfer fictitious assets. Those are assets that B couldn't take over. Questions do have them. You realize from the balance sheet, there's an asset called goodwill. When you look at the question, there is nowhere you are told company A, company B took it. Or maybe you have an asset called copyright, patent. You don't see anywhere where they are told company B took it. So it is obvious who takes over the loss of that asset. It's the owners of the company. So those steps 7, 8, and 9 will always be there. Number 10 will also be there. If your company has preference shareholders, you have to close the preference share capital again. Then once you have done that, listen, you have only been updating the accounts up to number 10. Now you know what you owe to A or ordinary shareholders. Now you know what you owe to the preference shareholders. Now you receive the purchase because you charge them. Now receive. I told you the question will tell you what is it that they are paying you. Is it cash, shares, or debentures? The question will guide you. Receive them. That's number 11. You are receiving from a data called the purchasing company. Once you receive, get the general picture. Now you have opened two liabilities, or whichever liability. If preference shareholders are not in the company, then you don't open preference shareholders members. You only open ordinary shareholders members. But once you receive, you now know, I must pay my liabilities, me as company A. So you go find out, who are you paying? We started by saying, if your company has preference and ordinary, who ranks first? Preference. That's why we went to number 12, pay the preference. I've told you, listen, among the assets you received, the question will tell you what is it that you are using to pay the preference. Use it accordingly. Once you pay the preference, there could be a balance in the account. Normally, there will always be a balance. That balance, I've told you, will either be a gain or loss on payment. Transfer to the realization. Once you pay the preference, now you are remaining with the ordinary. But before you pay the ordinary, you need to know, did we sell our business at a gain or loss? That's our step number 14. Getting the balance in the realization account, being either gain or loss on realization. Give it to the ordinary shareholders. They are the owners of the company. Once you have done that, the last person to be paid are the ordinary shareholders. Good. Now allow me to discuss the entries in the books of the purchasing company now. There are not many, so let me discuss them first. There are not many entries in the books of the purchasing company. Entries in the books of the purchasing company. So which I am assuming it's company B in our illustration now. So allow me to go through them. There are normally 6 accounting entries. There are 6 of them. Let me go through them first. Now, in the books of the purchasing company, listen, in the books of the purchasing company, their major account is an account we shall be calling business purchase. For them, the major operating account, we shall be calling it business purchase. So let me go through. There are 6 accounting entries. Number 1, UB, with the purchase consideration. Listen, what am I being charged? I'm looking at myself now as B. What am I being charged by company A? We have been assuming 50 million. Listen, so me B, I am being charged by company A 50 million. Listen, so I create a liability now to be paid in future. So me B, I owe A 50 million. So with the purchase consideration, you will debit business purchase, you will credit the selling company. And our selling company is A Limited. So you debit business purchase and you credit the selling company, which is A Limited, 50 million. This time, you are creating a creditor. In the books of the purchasing, we were creating a debtor. Now you are creating a creditor by the name of A Limited. Good. That's our entry number 1, which says, with the purchase consideration, you debit business purchase, you credit the selling company. That's number 1. Number 2, UB Limited, with the liabilities you took over from A, UB, with the liabilities you took over from A, those liabilities become your own. So you will go and credit all the liabilities. We know liabilities are always a credit balance. So whichever liabilities you took over, the question will tell you either bank overdraft, creditors, bank loans, and so on. Whichever liabilities you took over, they became your own. So you credit the liabilities and you debit business purchase. That's number 2, which says, with the liabilities taken over, you debit business purchase and you credit liabilities. That's number 2. Number 3, with the assets taken over, you took over some of their assets. Now I want you to listen. the question will tell you, listen, at what value did you take them over? So we are saying, number 3 is, with the assets taken over at agreed values. At agreed values. Listen, that you will be told by the question that company B took over motor vehicle at this value, furniture at this value. Maybe you're told the company B took over the following assets at their fair values. This much. Listen, I want you not to confuse. In the books of the selling company, our number 1 entry was close all assets taken over at, listen, at their book values. Let me show you. In the books of the selling company, we were closing the assets how? At their book values. I hope you can see that. Number 1, close all assets taken over at their book values. So the selling company was closing them at their book values. You B, who is taking them over, the question will tell you at what value are you taking them over. So our number 3 entries in the books of the purchasing company is, with the assets taken over, at agreed values, you will debit the assets, because assets are always a debit balance, and you credit business purchase. With the assets taken over, you debit business purchase, you debit assets and you credit business purchase. That's number 3. Number 4, there will be a balance in this business purchase account. There will be a balance in this business purchase. I want to illustrate. That balance in the business purchase will either be what we shall be calling goodwill, or it will be what we shall be calling capital reserve. Let me explain. You are buying this business, you B, and you will pay 50 million. That's the purchase consideration. If you compare, listen, these are the assets you are taking over, and this is the liability you are taking over. If you net those two, you remain with what we call the net assets taken over. You have assets you took over and the liability you took over. So you remain with what we call net assets taken over. Now let's just assume that the net assets you took over from A were 45 million. While the purchase consideration is 50, that's what you will pay. But the assets you are taking over are 45. The question is this: why should I pay more to acquire less? Why should I pay more to acquire less? I must be buying something else. So you B, you must be buying the goodwill of the company A. And that 5 million difference, which will be on this side, you will now consider it as goodwill. So you will debit goodwill and you will credit business purchase. What if the purchase consideration now is 50, but the net assets you are taking over from A, are 55? The net assets now are more than what you are paying. So you are paying less to acquire more. It is obvious. If you B, you are paying less to acquire more, then you must have bought this business at a profit. You must have bought that business at a profit. Listen, that profit, we normally consider it as a capital reserve. So if it's a profit on purchase, the difference will be on the debit of the business purchase. You will debit business purchase and you will credit capital reserve. So that's our step number 4, which says, with the balance in the business purchase, being either goodwill or capital reserve. I've told you, if the purchase consideration is higher than the net assets taken over, the difference is goodwill. So you will debit goodwill and you will credit business purchase. Also told you, if the purchase consideration is less than the net assets taken over, we have said the difference is a profit. It's a profit on purchase. This profit should be considered as a capital reserve. So you will debit business purchase and you credit capital reserve. That's our entry number 4. Number 5. A time has come now, listen, a time has come now for you, B, to pay A. You owe them this 50 million. So a time has come for you to pay them now. Listen, we have assumed in the previous books of the selling, we have been assuming that B gave cash of how much? 10 million. B gave debentures worth how much? 20 million. And B gave shares worth how much? 20 million. That's what we were assuming. So let me now go to step number 5. Number 5 says, with cash, listen, with cash or debentures given, with cash or debentures given as a payment of the purchase consideration. You are using your cash or the debentures as a payment of the purchase consideration. You will debit the selling company and credit cash or bank, that 10 million. If you are issuing debentures, you will debit the selling company and credit debentures by that 20 million. That's step number 5. I've not touched on the shares. Number 5 says, with cash or debentures given as a payment of the purchase consideration, you debit the selling company and you credit cash or you credit debentures. That's number 5. Number 6 and the last one. Listen to this carefully now. If you are issuing shares as a payment, which we are assuming you have, you issued shares worth how much? 20 million. Listen, you are the company issuing these shares. Listen, because you are the company issuing the shares, you must credit share capital. You will have to go back to the question and find out. Yes, you issued shares worth 20 million. How much of this 20 million, listen, how much of that 20 million is the nominal value of the shares and how much of it is the premium on the shares? Because you could have issued these shares at a premium. And you know from your accounting knowledge, when shares are issued, you normally don't take the amount of the premium to the share capital account. You know that. The amount of the premium must go to the share premium account and the nominal value of the shares must go to the share capital account. So let us assume that from the question, out of the 20 million, we want to assume 15 million was the nominal value of the shares, while 5 million was the premium on the shares. So you will debit, you are paying A using the shares. So number 6, we are saying when shares are issued as a payment, when shares are issued as a payment of the purchase consideration, listen, with the nominal value of the shares you are issuing, you will still debit the selling company and credit share capital, 15 million. And if the shares are issued at a premium, with the premium on the shares issued, you will still debit the selling company and you'll credit share premium, that 5 million. That's what we are saying. Listen carefully. I want to take you back to the books of the selling company. When we were dealing with the books of the selling company here, we saw company A received shares worth 20 million. That was under step number 11, where we were saying with the receipt of the purchase consideration, either in form of cash, shares, or debentures. I told you, if you are receiving cash, you debit cash. If you are receiving shares, you debit shares. You can see on the left here, we debited shares by how much? 20. Listen, in the books of the selling, they did not bother to know how much of the 20 is the nominal and how much of the 20 is the premium. Why? Because them, they were not the company issuing, they were receiving shares. So they were receiving it as an asset, not as the issue of shares, no. So company A did not bother to ask themselves, this 20 million worth of shares, how much of it is the nominal? No, because they are not issuing the shares. They are not going to credit share capital. They are receiving the shares. But you B, who is issuing the shares, you must credit share capital. And I've told you, you cannot credit share capital with any amount of the premium. If you are issuing the shares at a premium, then the premium must go to the share premium, the nominal must go to the share capital. If the whole 20 million is the nominal, meaning there was no premium, then you credit share capital with the whole 20. But if part of the 20 is the nominal, part of the 20 is the premium, that's why we are saying you as B, you must separate. That's what we are saying. Number 6 is when shares are issued as a payment of the purchase consideration, then with the nominal value of the shares issued, you will debit the selling company and you will credit share capital. And if the shares are issued at a premium, then I'm saying with the premium on the shares issued, you will still debit the selling company and you credit share premium. Those are the 6 official accounting entries in the books of the selling company, or in the books of the purchasing. Number 1, I've said with the purchase consideration, you debit business purchase, credit the selling company. Number 2, with the liabilities taken over, they are yours now. Debit business purchase, credit liabilities. Number 3, with the assets taken over, they are yours now. Debit assets, credit business purchase. Number 4, with the balance in the business purchase being either goodwill or capital reserve. We have explained it. That's number 4. Number 5, we have said with cash or debentures given as a payment of the purchase consideration, you debit the selling company and you credit cash or debentures. And finally, number 6, when shares are issued as a payment of the purchase consideration, then I've said with the nominal value of the shares issued, you debit the selling company, you credit share capital. And if the shares are issued at a premium, then with the premium on the shares issued, you debit the selling company and you credit share premium. Good. So with that now, let's put down those entries now. So have a subheading, entries in the books of the selling, in the books of the purchasing company. Entries 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 in the books of the purchasing company. Number 1, with the purchase consideration. With the purchase consideration, debit business purchase, credit selling company. For the selling company, you can put in bracket creditor. In our case, we were assuming company A. We don't know what name the question will give you. But whatever is the company which is selling to you, you debit business purchase, you credit the selling company. That's number 1. Number 2, with the liabilities taken over, with liabilities taken over. With liabilities taken over. With liabilities taken over. Debit business purchase. Debit business purchase. Credit liabilities. Debit business purchase. Credit liabilities. With the liabilities taken over. Debit business purchase. Credit liabilities. That's number 2. Number 3. Number 3. Number 3. With the assets taken over. With assets taken over at agreed values. With the assets taken over at agreed values. With the assets taken over at agreed values. Debit assets. Credit business purchase. Debit assets, credit business purchase. Debit assets, credit business purchase. That's number 3. Number 4. Number 4. Number 4. With the balance. Number 4. With the balance in the business purchase. With the balance in the business purchase. With the balance in the business purchase. Being either, with the balance in the business purchase, being either goodwill or capital reserve. With the balance in the business purchase, being either goodwill or capital reserve. Then you come and say this, number A, under that. So I've said with the balance in the business purchase being either goodwill or capital reserve. Number A, under that. Number A, semi-V. If, number A, if the purchase consideration is higher, if the purchase consideration is higher than the net assets taken over, if the purchase consideration is higher than the net assets taken over, comma, the difference is goodwill. If the purchase consideration is higher than the net assets taken over, the difference is goodwill. Debit, goodwill, credit, business purchase. Debit, goodwill, credit, business purchase. Debit, goodwill, credit, business purchase. Number B, under that. Number B, under that. If, number B, if the purchase consideration, number B, if the purchase consideration is less than, if the purchase consideration is less than the net assets taken over, if the purchase consideration is less than the net assets taken over, then the difference is a profit on purchase. If the purchase consideration is less than the net assets taken over, comma, the difference is a profit on purchase. Difference is a profit on purchase. Will you stop? This is considered as a capital reserve. This is considered as a capital reserve. This is considered as a capital reserve. Debit, business purchase. Credit, capital reserve. Debit, business purchase. Credit, capital reserve. That's number 4. Number 5. Number 5. Sema hivi. Number 5. With cash or debentures. Number 5. With cash or debentures given. With cash or debentures given as a payment of the purchase consideration. With cash or debentures given as a payment of the purchase consideration. Debit, selling company, bracket, remember now we are paying a creditor, we debit, selling company, credit cash, stroke debentures. Credit cash, stroke debentures. Say number 5, with cash or debentures given as a payment of the purchase consideration, you debit selling company because you are now paying them, and you credit cash, stroke debentures. That's number 5. Number 6 and the last one. Number 6 and the last one. Number 6 and the last one. Number 6, when shares are issued. Number 6, when shares are issued as a payment. When shares are issued as a payment of the purchase consideration. When shares are issued as a payment of the purchase consideration. When shares are issued as a payment of the purchase consideration. Under that, number A. Under that, number A. With the nominal. Number A, with the nominal value of the shares issued. 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 Debit, selling company, in bracket creditor, remember you are paying them. Credit share capital. With the nominal value of the shares issued, debit, selling company, credit share capital. B, under that, number B, under that, number B, if the shares are issued at a premium. Number B, if the shares are issued at a premium. If the shares are issued at a premium, comma, then if the shares are issued at a premium, comma, then with the premium on the shares issued, with the premium on the shares issued, with the premium on the shares issued, debit, selling company, bracket creditor bado, credit share premium. Credit share premium. Debit selling company, credit share premium. Good. So we are through with the 6 official entries in the books of the selling and the books of the purchasing company now. So before we do an example, I want to mention 1 or 2 other points. Before we do an example now, I want to mention 1 or 2 things. I want to take you back to the accounts. These are journals. But let me take you back to the accounts now. I want to say something. Now listen. Listen to this now. I have been assuming that the purchase consideration in our question was 50 million. I want you to listen. I've been assuming that the purchase consideration was 50 million. But most of your past papers, whenever they're testing you on this, they will not give you that amount we are calling the purchase consideration. Most questions will not give you that amount we are calling the purchase consideration. Normally, it is your responsibility to determine that amount. You need the 50 million, whether in the books of the selling or in the books of the purchasing. In other words, you need the amount called the purchase consideration. Either way, you need it. So how can I get it? Listen, the examiner will give you all other information. The examiner will give you all the other information that you need. He will only deny you the amount of the purchase consideration. But he will tell you everything else. So the question is this now. How do I determine this 50 million? Now listen. You, company B, or you as a student now, to determine how much is it, listen, how much is it costing company B to buy A? How much is it costing company B to buy A? I've told you, the examiner will tell you everything else, except he will not give you the 50 million. But can I get the same 50? The answer is yes. Listen, you will go through the question and realize that the company B is giving out cash worth 10 million as part of the payment. Company B is giving out debentures worth 20 million as part of the payment. Then you realize company B is also giving out shares worth another 20 million as a payment. So it is obvious, therefore, that if I can add from the question all the various forms of payments that company B is doing, then if I add all of them, then automatically I should be able to get the purchase consideration. Now listen. So you will go through the question and find out what is it that B, listen, what is it that B is giving to the owners and financiers of company A. You will go through the question, finding out what is it that company B is giving to the owners and financiers of company A. For example, the question might tell you, to the ordinary shareholders of company A, you B, to the ordinary shareholders, you B, you are giving them cash worth 10 million. Then you read another paragraph somewhere and you realize, to the preference shareholders of company A, you B, you are giving them your debentures worth 20 million. Then you read somewhere again and you realize, to the debenture holders of company A, because they're also financiers, you B, you are giving them your ordinary shares amounting to 20 million. So it is obvious, therefore, listen, it is obvious, therefore, that when I add all the various forms of payments, to the owners and financiers of the selling company, then I get that 50 million. So to determine the purchase consideration, we shall be adding up all the various forms of payments to the owners and financiers of the selling company. This could be in form of ordinary, could be in form of cash, could be in form of debentures, whatever it is. Now listen. Before we conclude there, listen. One time I told you, especially when we were dealing with the books of the selling company, I told you, company A must liquidate themselves so that they sell their business to company what? To company B. I told you that company A must liquidate themselves so that they sell their business to company B. Then I told you, company B may need 2 million, company A may need 2 million shillings to liquidate themselves. But suppose they did not have that money to liquidate themselves. So you B, you decided that you will also give them that 2 million so that they can liquidate themselves. Listen, so you read that from the question that the liquidation expenses of company the liquidation expenses of company A were paid for by B on behalf of A. Listen, then you also read, you B, you gave cash worth 10 million. You B, you gave debentures worth 20. You B, you also gave shares worth 20. So here you are giving a total of 15. But still, listen, still on top of this, I also gave the company A, me B, I also gave them another 2 million shillings so that they can liquidate themselves. So the question is, how much did it cost me to buy A? It is not 15. It must be 15 plus the 2 million to give me 52 million. What is that 2 million? It is the liquidation expenses. Now listen. If A paid it on their own, that 2 million, if the A Limited paid it on their own, then it will not cost B. But now we are adding it here because we are assuming the question tells you that 2 million was paid by B on behalf of A. So to know how much it will cost you, then listen, we are saying to determine the purchase consideration, you will add all the various forms of payments to the owners and financials of the selling company. Then I'm going on to say, if the liquidation expenses of the selling company are paid for by the purchasing company, then they should be added. That liquidation expenses should be added in the determination of the purchase consideration. Otherwise, if you A, you paid it on your own, then it doesn't cost B. We only add it on one condition, that it is you B who paid for it. Okay? Otherwise, to get the purchase consideration, go through the question, finding out what is it that you B, you are giving to the owners and financiers of the selling company. Good. So maybe before we do that, let's put down, before we do an example, let's put down now that NB note. Andika NB note. NB note. Then you say this, to determine the purchase consideration, to determine the purchase consideration comma, we add up all the various forms of payments. To determine the purchase consideration, comma, we add up all the various forms of payments, to the owners and financiers, of the selling company. We add up all the various forms of payments to the owners and financiers of the selling company. Will you stop? This could be in form of, continue, this could be in form of cash, shares, or debentures. This could be in form of cash, shares, or debentures. This could be in form of cash, shares, or debentures. Another paragraph. If the liquidation expenses, of the selling company, are paid for, by the purchasing company, comma, this should be added in the determination of the purchase consideration. This should be added in the determination of the purchase consideration. If the liquidation expenses of the selling company are paid for by the purchasing company, comma, this should be added in the determination of the purchase consideration. Good. That's okay now. I think we are through with the accounting entries. You need to remember the 15 accounting entries in the books of the selling, and you need to remember the 6 official accounting entries in the books of the purchasing company. Then I've said, either way, you still have to know how do we compute the purchase consideration. That one you have to do it in almost all your questions. Good. Now, I have no time to start and complete an example or a question. What we shall do next time, we shall now do a past paper question applying what we have already done. Now, for the sake of the new students who are here today, because today it was a free class, for the sake of the new students, listen, if you wish to continue with us for advanced financial reporting, for the online classes, then we have early morning classes and we have evening classes. If you wish to continue, for the early morning classes, we start from 5:30 in the morning to 7 a.m. in the morning. That is every Monday, Wednesday, and Friday. That is for early morning classes. For evening, it's from 8 p.m. to 10 p.m. Again, every Monday, Wednesday, and Saturday. Monday, Wednesday, and Saturday. Listen, our system is such that in case you miss a class, let's assume you are in the evening group, and on Saturday you have a function or you are working late, does it mean you will miss that class? The answer is no. Listen, you can still go back to the group where the link was posted and you can be able to watch your video at your own free time. So in case you miss a class, don't panic, whether it's early morning or evening, just go back to the group, click on the link of the video you want to watch. Because you missed it, you will be able to watch it at your own free time. Or maybe I've taught you a class and you feel you want to listen to the class again, just go back to the group and click on the video you want to listen to again. You will be able to listen to it as many times as possible. So we are saying you either take early morning or evening. Now, there are some students who are not available in the early morning or evening. For them, you can buy what we call pre-recorded videos, where you get the videos for the whole syllabus at once, so that you listen to the videos at your own free time, at your own pace, If you feel you can't be available in the early morning or you can't be available in the evening and you want to join the advanced financial reporting, then you can buy what we call the pre-recorded videos. Currently, we are charging 4,000 shillings. We also accept payments in installments. That's what we are accepting. If you want to reach me now, you can call me through this number. You can call me through this number, 0722 65 8875. 0722 65 8875. Okay? That's what you can do if you want to reach me or find out anything concerning the course. Now, for some of you, listen, for some of you, you are friends who are doing financial reporting of the intermediate level or what used to be called Section 3. So if you have friends who are doing financial reporting, we also have a class for them. That class, again, is from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday. The charges are still 4,000. They can also buy the pre-recorded videos, no problem. They can also buy the pre-recorded videos for the whole syllabus. Again, if they miss a class, they can still watch the video. Some of you, again, have friends who are doing financial accounting of Section 1, or what we are now calling foundation level, or for ATD1 and ATD2. We also have classes for them. So in case you have friends who are doing those other subjects, the financial reporting of the intermediate level or Section 3, and financial accounting of Section 1, or what you call foundation level, let me know. They can also be taught. Good. Now, I think I've mentioned everything. Now, again, listen. If you join now, listen. If you join now, you will still be able to get the videos. You will still be able to get the videos of all the previous classes. You will still be able to get the videos of all the previous classes. So don't panic that already I've taught some classes which you will miss. No, you will be able to get the videos of the previous classes. Good. My appeal again to you is, please, if you have not subscribed to my YouTube channel, please subscribe to my YouTube channel. Just go to the subscription button down there. Click it even now if you have not subscribed. If you want to watch my videos later, my YouTube channel is called CPA Joseph Njuguna. CPA Joseph Njuguna. So go to the YouTube channel by that name. You will be able to find out some of the other videos. And please subscribe and click on the subscription button. Subscribe and click on the subscription button so that you can be able to be notified whenever we post some new videos into the group. Somebody's asking a question. Let me answer that one first. This is who? James. James is asking, if the liquidation expenses are paid for by the purchasing company and added to the consideration, are we still going to create a provision? Yes. Yes. Why? Listen, James. It is a cost of who? It is a cost of the selling. So in their books, they only incurred but never paid. Who paid for it? It is B. James, I hope you are listening. Who incurred? It is A who incurred that cost. It is their cost. They are supposed to pay for themselves. So they incurred but never paid. So them, they will still create that provision. Are you listening? Then, when now B will be paying, he will pay you the shares 10 million, cash, shares 20 million, cash 10 million, plus debentures worth 20 million, plus he will also give you another 2 million. Because you created a provision, now you will receive the 2 million. Then you will pay now. I hope you are following, Mr. James. Yes, you have said yes. That, yes, you will still create your provision because you have incurred the 2 million, but you did not pay. Who paid for it? It's B. So it is even costing them more. So when B will be paying you, will be giving you 52, not 50. B will pay you 52. so that this 2 million, you can use it to pay for your liquidation expense. Okay, James, you have said you're okay now. Otherwise, for the rest, see you next time when we shall now do a past paper question. Unless there is another comment, maybe from a student. Okay, James, you have said you have understood. Thank you. Any other comment, maybe from a new student who would wish to know something, apart from what I've said about them subscribing, them joining the class? Maybe somebody has a comment. So if there is no comment, maybe we can call it a night. See you next time. Good night for now. Good night for now, where we shall meet next time and now do a past paper question. So for those who are interested, you can call me on this number, 0722 6588. Hi. That is Little Angels. Angels, call me. You have said hi. Call me after this on that number or text. I'll pick it. Daniel, no, that's who? It is for the advanced financial reporting, those who are sitting for the exams in April. It does not matter whether you are sitting in April or what, so long as you are doing advanced financial reporting. Yes. We shall complete the syllabus before you do your exams. Kennedy, we shall complete the syllabus before you do your exams. That one I know. We shall have to complete. Okay. Okay, so Little Angels, call me after this. Okay, good night. Hope the next time will be free. No. Who is this? Catherine. Call me. We shall talk. Not all classes will be free. No. Call me. We can talk on the modalities. Yeah. Good night. You have enjoyed the topic. Kiama, thank you. Enjoyed the topic. Sawa. Otherwise, good night now. Catherine, you can call me. You have said the next one will be free. Not all of them. No. But you can call me. We can talk. For Little Angels, you can also call me after this. Otherwise, let me switch off the class. Otherwise, good night for now. Bye. Good night.